Welcome to XM.com. You're watching today's Daily Market Comment by Mario Satikiriakos. I'm Cristina Marujos. The battle for the yen continues to rage in the FX arena, with Japanese officials using every trick at their disposal to stabilize the devastated currency. A double salvo from the Bank of Japan and the government yesterday, where they dialed up intervention threats, stopped the bleeding for a few hours, but the yen's wounds opened up again on Thursday following a record-breaking trade deficit. Shifting trade flows has been a thorn in the yen's side this entire year, compounding the pressure from widening interest rate differentials. Japan used to run a chronic trade surplus, but with energy prices going through the roof and the nation importing most of its power from abroad, this has flipped into a gaping deficit, depriving the yen of its main historical advantage. Market participants have concluded that Japanese authorities can threaten FX intervention all they want. They are still unlikely to pull the trigger, and even if they do, it won't have a lasting impact. The only player that can turn the tide is the Bank of Japan, which meets next week, although the appetite among policymakers for any strategy shift is low because the outlook for inflation and wages remains muted, making it hard to trade the yen in either direction. After an explosive start to the week in most asset classes, markets calmed down on Wednesday. Most major currency pairs remain trapped in narrow trading ranges, taking a breather from all the volatility following the U.S. inflation report. European officials unveiled plans to negate the fallout of the energy crisis. This is certainly a step in the right direction to avert an economic meltdown, but not the magic bullet some investors anticipated, hence the lack of enthusiasm in the euro. Meanwhile, Wall Street closed in the green, stabilizing after the heavy losses as bargain hunters dipped their toes back into the market. The elephant in the room is the next week's Fed meeting, where traders are pricing a 1 in 3 chance of a shock and awe full percentage point rate increase. Gold cannot escape the Fed inferno without Burns either. With the dollar powering up and real U.S. yields going ballistic to reach multi-year highs, the precious metal has taken heavy damage as the opportunity cost of holding onto it increased sharply. Bullion is approaching the danger zone around $1,680 an ounce, which served as a springboard for the price action several times after the pandemic, and now includes the 200-week moving average as an extra layer of protection. Thank you for watching today's Daily Market Comment here at XM.com.